Chapter 8. A closer look at gold derivatives. First, let's have a look at the history of gold ETFs, which in fact is rather short. The first thing to notice is that gold ETFs are a quite recent phenomenon. As this chart shows, the gold ETF holdings exploded since the introduction of GLD in 2004. GLD, which is issued by SPDR Gold Shares, is by far the largest ETF circulating at the moment. As this chart shows, gold ETFs claiming to hold over 1500 tons of gold have been issued since 2004. To put this amount in perspective, every year a total of about 2500 tons of gold is mined worldwide, and central banks are not allowed to sell over 400 tons of gold a year as a net total. So where did the issuers of ETFs get all the physical gold from to back up their derivatives? Did they really drain the market supply for gold, or did they just invent the gold? For years, the identifiable demand for gold is a net total of around 3500 tons a year. In between the second half of 2008 and the first half of 2009, gold derivatives in worth of over 600 tons of gold were created. When, according to the World Council of Gold, the investment demand for gold is 90% of the total demand, the demand for gold in ETFs as a fraction of total trading and investment demand would account for almost the whole investment demand for gold this year. And we all know that not every investor bought gold ETFs instead of the physical metal, so something seems a bit odd here. So let's have a closer look at what is going on with these gold ETFs by examining the world's largest gold ETF, which is GLD. On this slide, the major reasons to be skeptical about the idea that investment vehicles like GLD will increase the demand for physical gold are being noted. The first reason to be skeptical is that the figures indicate that significant increases or decreases in demand for ETFs do barely cause the price of gold to rise or fall. The second reason is that gold ETF shares like GLD can be sold short, and short selling GLD shares tunnels money to already via GLD owned gold. This distorts the actual demand for physical gold on the market. Third reason is clauses in the GLD prospectus raise questions to whether GLD as an investment vehicle is in reality really as safe and good as gold. And the fourth reason is that when audited, only half of the bullion bank's ETFs liabilities are audited, and the short positions holdings are not. The fifth reason is that the COMEX allows futures contracts to settle with ETFs, which the COMEX perceives to be as good as physical gold itself. And the last reason is that the COMEX warehouse stores far less physical gold than there are paper claims to gold traded. Now, first let's have a look at the first reason to be skeptical about GLD. Between December 31st, 2008 and April 6, 2009, GLD added 62% of the at that time available world production of gold to its reported gold holdings. Yet the price of gold moved from $869 an ounce to $870 an ounce. So how come the price of gold did not explode when for every 10 ounces of gold mined in the world that period, 6 went to the vaults of GLD? To me it seems there is no logical explanation for this other than GLD does not really collect all the physical gold their ETFs hold claims to. And now let's take a look at the price action of gold between April and December 2009. In respect to the GLD holdings, on December 16, 2009, GLD claimed to have only 11 tons of gold less than it recorded on April 6, 2009. Yet the price of gold has risen over $250 an ounce, or almost 29%. The correlation between the price of gold and GLD's recorded ownership is tenuous, which should justify serious question marks about the validity of the assumption that GLD really holds the physical gold it claims. And when looking at this news article from 2007, the question marks about discretion should grow even larger. Apparently Morgan Stanley rather paid $4.4 million than had auditors have a look inside their gold vault to check if the gold they claimed to have in possession really was in their vaults. The second reason to be skeptical about GLD is that selling short gold derivatives tunnels money away from buying and removing physical gold from the market. On this slide it is demonstrated that money that flows to GLD shares that have been sold short flows at least temporarily to the broker instead of to the physical metal itself. I should point out though that the $1,000 marked in yellow at the broker are not profits for the broker. Eventually the broker has to return this money, or at least a large part of it, to Charlie. But as long as there are short positions of gold ETFs, there is investment money sitting on the accounts of large banks that should have been directed to physical gold in order to have its price reflect the true market demand. On this slide you can see how much money is involved in shorting GLD shares. It is the sum of about 1.53 billion of dollars that is sold short. Can you imagine the price of gold right now if all this money had flown to the metal itself instead of the bullion banks? This reason to be skeptical about GLD should be reason alone to steer away from GLD when buying gold as an investment.